Deep in the crust of the Earth, intense heat and pressure fuse carbon atoms into a crystalline lattice. The resulting mineral is exceptionally hard, highly refractive, and, contrary to popular belief, remarkably abundant. Yet, for over a century, this common arrangement of carbon has commanded astronomical prices, symbolizing eternal love, immense wealth, and unyielding status. This profound disconnect between geological reality and market value is not a natural economic phenomenon. It is the meticulously engineered outcome of what is arguably the most successful illusion in the history of modern commerce. Exposing the mechanisms behind this illusion requires dismantling the legacy of a single entity that achieved total dominance over an entire global industry. For decades, the DeBeers Corporation operated not merely as a mining company, but as a sovereign economic force. By orchestrating a long-standing corporate cartel, DeBeers dictated the laws of supply and demand, effectively overriding the natural mechanics of free enterprise. This was not a standard business operation, but a masterclass in market manipulation, demonstrating how absolute control over a commodity's flow can completely fabricate its intrinsic worth. The foundation of this global diamond monopoly was laid in the dust of late 19th century South Africa. In 1867, the discovery of the Eureka diamond near the Orange River triggered a massive influx of prospectors. Thousands of independent miners descended upon the region, frantically digging into the kimberlite pipes of Kimberley. As the sheer volume of extracted stones flooded the market, prices plummeted. The fundamental economic truth became terrifyingly clear to the investors funding these operations. If diamonds were easy to find and widely available, they would become entirely worthless. Enter Cecil Rhodes, an ambitious British imperialist and financier who recognized that the only way to save the diamond industry was to eliminate competition entirely. Arriving in Kimberley in the 1870s, Rhodes did not focus on digging. He focused on consolidating. Financed by European banking dynasties, he began aggressively buying out rival claims, systematically absorbing independent operations into a unified conglomerate. By 1888, Rhodes had successfully merged the largest mining interests to form DeBeers Consolidated Mines, effectively capturing the vast majority of the South African diamond mines and securing unprecedented leverage over the raw material. With control over the physical source secured, the company faced its true monumental task: engineering artificial scarcity. In classical economics, price is determined by the equilibrium between supply and demand. If a resource is plentiful, its price drops. To maintain the illusion of rarity and protect their colossal investments, the newly formed syndicate had to ensure that the global supply of diamonds was choked to a deliberate, agonizing trickle. They realized early on that they were not simply selling a mineral, they were selling scarcity itself, and scarcity required absolute authoritarian control over distribution. To execute this strategy on a planetary scale, the corporation established a highly sophisticated distribution network known as the Central Selling Organization. This entity acted as a massive, centralized vault and clearinghouse for the entire industry. Instead of selling rough stones directly to the open market, the cartel required all producers within its network to funnel their entire yield through this single, tightly controlled choke point in London. The Central Selling Organization became the ultimate gatekeeper, possessing the power to stockpile immense quantities of rough gems in heavily guarded vaults whenever global demand weakened, thereby preventing sudden price crashes. The mechanics of this single-channel system were ruthlessly efficient and entirely uncompromising. 10 times a year, a select group of authorized buyers, known as sight holders, were invited to the London headquarters. They were presented with a small box of rough diamonds, meticulously sorted and priced by the syndicate's internal experts. There was absolutely no negotiation permitted. The sight holders either accepted the box at the predetermined, non-negotiable price, or they were permanently exiled from the global trade. This draconian take-it-or-leave-it protocol ensured that prices never fluctuated downward, effectively insulating the global diamond market from the natural volatility of standard economic cycles. However, The architecture of this monopoly faced an existential threat in the 1930s. The Great Depression wiped out vast swaths of global wealth, and the demand for luxury goods evaporated almost overnight. The vaults in London were overflowing with unsold inventory, and the carefully constructed illusion of scarcity was on the verge of total collapse. Controlling the supply was no longer sufficient to guarantee survival. The syndicate realized they had to achieve something far more difficult and abstract. They had to engineer an infinite, unyielding demand that could withstand severe macroeconomic downturns. In 1938, the corporation hired the Philadelphia-based advertising agency N.W. Ayer to fundamentally alter the psychological landscape of the American consumer. The objective was not merely to promote a specific corporate brand, but to embed a profound concept deeply into the cultural subconscious. The agency recognized that diamonds had to be transformed from a luxury adornment for the ultra-rich into a mandatory psychological necessity for the expanding middle class. They needed to inextricably link the carbon crystal with the abstract concept of romantic devotion, creating a social imperative that transcended logical financial calculation. The resulting campaign birthed the slogan, "A diamond is forever," a phrase that would become the most potent psychological weapon in the cartel's arsenal. Through relentless product placement in Hollywood films, carefully orchestrated celebrity endorsements, and ubiquitous print advertising, the agency fabricated an entirely new social tradition. They convinced the public that the only acceptable symbol of an engagement was a diamond ring, and they even dictated the specific financial metric, suggesting that a man should spend 2 months of his salary on the stone to prove his worth. The sheer genius of this marketing triumph lay in its secondary, hidden economic function. It transformed a highly liquid commodity into a permanently illiquid asset. By branding the diamond as a sacred, eternal symbol of love, the campaign effectively destroyed the secondary market. A consumer who believes a diamond represents their unique, everlasting relationship will almost never sell it, regardless of financial hardship. By convincing millions of people to lock millions of diamonds away in family jewelry boxes, the advertising campaign performed the ultimate act of supply suppression, perfectly complementing the physical stockpiling happening in the London vaults. As the mid-20th century progressed, the echoes of this psychological conquest resonated globally, but new geological realities threatened the syndicate's absolute rule. In the 1950s, the Soviet Union discovered massive diamond deposits in the desolate permafrost of Siberia. This sudden, unprecedented influx of rough stones outside of the cartel's established control possessed the potential to flood the international market and shatter the carefully maintained price floor. The illusion of rarity, so meticulously cultivated over decades, was once again in profound geopolitical jeopardy. Recognizing the catastrophic risk to their empire, the cartel engaged in a masterstroke of geopolitical maneuvering. Rather than attempting to compete directly with the Soviets in an open price war, they secretly negotiated a covert agreement to purchase the entirety of the Russian production. Even during the height of the Cold War, when ideological divides fractured the globe and nuclear tensions escalated, the mutual financial interest in maintaining the profit matrix superseded international hostilities. The syndicate absorbed the massive Siberian yield, quietly funneling it through the central selling organization and preserving the artificial global price structure. When quiet diplomacy and massive capital reserves failed to secure compliance, the corporation deployed devastating punitive measures against rogue producers who dared to operate outside the single channel. In the 1980s, when the nation of Zaire attempted to bypass the syndicate and sell its industrial-grade diamonds directly to the open market, the cartel retaliated with overwhelming financial force. They deliberately flooded the market with their own massive stockpiles of similar grade stones, intentionally crashing the price of Zaire's specific product. The resulting economic devastation forced the rebel nation to quickly capitulate and return to the tightly controlled network. Yet, the sheer weight of a global monopoly cannot be sustained indefinitely against the relentless forces of globalization, technological advancement, and continuous geological discovery. The structural integrity of the cartel began to visibly crack in the late 20th century. In the 1990s, the massive Argyle mine in Australia, producing vast quantities of smaller, colored diamonds, made the unprecedented decision to break away from the central channel and market its yield independently. Shortly thereafter, significant high-quality deposits were discovered beneath the frozen lakes of Canada, operated by multinational mining conglomerates with no historical allegiance to the old syndicate. Simultaneously, the international legal environment surrounding anti-competitive practices grew increasingly hostile and sophisticated. The United States Department of Justice had long pursued the corporation for flagrant violations of antitrust laws, effectively banning the company's executives from operating directly on American soil without facing immediate arrest. As the new millennium dawned, the mounting pressure from independent producers, combined with the looming threat of massive legal liabilities and changing consumer ethics, forced a massive paradigm shift. The entity that had controlled up to 90% of the global rough diamond trade was finally forced to abandon its role as the market's absolute custodian. The corporation pivoted from its historical strategy of controlling the entirety of global supply to focusing on its own proprietary retail brand and localized mining operations. They systematically liquidated their massive, decades-old stockpiles, effectively ending the era of the central selling organization. The global diamond market transitioned from a pure, unyielding monopoly into a more fragmented oligopoly, where a handful of major mining companies now compete for market share, albeit within a broader structure that still largely respects the historical price floors established over the previous century. Today, the final insurmountable challenge to the concept of artificial scarcity has arrived in the form of laboratory-grown diamonds. By precisely replicating the exact intense heat and pressure found deep within the Earth's mantle, modern technology can now produce chemically and optically identical stones in a matter of weeks rather than billions of years. This technological disruption fundamentally severs the historical link between the stone and its geological rarity, forcing the traditional industry to constantly invent new narratives to justify the massive premium placed on stones mined from the earth. The century-long reign of this single entity remains one of the most profound and instructive case studies in the architecture of corporate power. It reveals that the financial value of an asset is rarely an inherent, unchangeable truth dictated by nature. Instead, value is highly malleable, capable of being entirely engineered through the aggressive consolidation of supply, the ruthless elimination of competition, and the masterful, generation-spanning manipulation of human psychology. The cartel did not merely mine a physical resource, they mined the fundamental human desire for status, security, and permanence. The legacy of the global diamond monopoly stands as a testament to the invisible forces that dictate the flow of wealth across generations. It forces a critical re-examination of the true cost of luxury and the complex mechanisms by which perceived value is constructed, defended, and ultimately dismantled. By understanding how a common, abundant mineral was transformed into the ultimate symbol of global wealth and romantic devotion, we illuminate the hidden matrix of incentives, corporate control, and psychological warfare that continues to shape the very foundations of modern global commerce.